Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just here to analyze the markets and talk about what's going on. First of all, the US dollar index has had a pretty significant rally for the past couple days as the Italian government 10-year bonds have been able to resume their downwards trend and the yields continue to go higher. So essentially what's happening is that bond investors are losing money on the coupon and interest rates continue to go higher. Now, of course, if in the event Italy doesn't default in the next 10 years, you will get paid the full amount of what you invest. However, if in the case Italy does default and goes bankrupt, all of those 10-year Italian bonds that were supposed to pay a full face value of 100 would no longer pay that full face value. And based on the risk metrics and the likelihood of that occurring, it continues to go higher by the day. Investors are continuing to sell their bond positions, and Italy has to borrow money at a much higher interest rate. So essentially what's going on right now is that Italy is paying more for interest than the typical mortgage, a typical person who has a mortgage here in the United States, which again isn't really a good thing considering the fact that if your mom and dad can go out and get a 4 or 5% mortgage, but a government entity can borrow money 10 years, not even 30 years. 30 years are even more expensive for Italian government bonds, but just a 10-year loan sits at around 7%. You could just imagine looking at a 30-year and paying even more money than what should be considered reasonable. And let me just pull out the stats real quick for Italian government bonds at the 30-year. And again, they're still at 7%. But earlier, they were at 7.5% earlier on in November. So again, it seems like the bond market wants to stage a new sell-off, and bond yields are going to stage a new rally. And going into this, if you're a bond speculator, chances are you would want to short the bond market. How you would do that would probably involve creating some sort of derivative contract and perhaps making an options bet. And again, that's much more specialized, and there's not really much of an open market for trading options on bond notes. But if there is, and chances are there are, put options on Italian bond notes would probably be very profitable, all things considered. So again, that's really specialized, and it's based on a certain market segment. So again, I don't really trade those type of securities. I don't trade options on bond securities, but if they do exist, I would definitely buy put options on Italian bonds. Moving on, let's go ahead and talk about the Dow Jones Industrial Average and the Euro-US dollar. Euro-US dollar seems to be on a continued downwards trend. However, on Sunday, we seem to have been able to trade flat Saturday, Sunday. And again, the way I see it, it's actually Sunday. So on Sunday, we traded relatively flat. Again, I'm not too certain where markets want to take this. I think everybody's waiting to see how European bonds trade, and primarily Italian bonds. Italian bonds remain at around 7%, and they're doing it over a prolonged period of time, which isn't very good, especially for 10-year notes. So again, if we continue to stick around 10% or 7% for a prolonged period of time, it could only mean the worst. Again, historically, anytime a government has been able to reach a 7% 10-year bond yield, it has always led to bankruptcy. So again, those are the stats against you. You have a 100% likelihood at this point of default. So under the event, a lot of European countries go bust. I'm pretty sure the euro will stick around, but many people will lose trillions of dollars in bonds or bonds just because the governments were unable to pay back the people who held onto those bond notes. That being said, that would be very deflationary in nature, and either you have a bond market collapse where one portion of the population loses a lot of money, or you have another portion of the population where the government is able to get a positive account balance, but at the expense of cutting back perhaps 30 to 40% of the public sector workforce. So no matter which way you look at it, somebody has to lose money, And because somebody has to lose money, that's going to dampen the economic growth coming out of Europe and perhaps lead it back into a recession. If you go back into a recession, the likelihood of being able to make money investing into European securities does dwindle down to an unlikely event. So again, for the most part, I would be playing these markets very defensively. I would buy into longer-term investments and perhaps consider non-cyclical investments, bonds, most likely Japanese bonds, and I would try to avoid high beta stocks, period. Okay, US dollar, Japanese yen, it has been able to fall down to new all-time lows. Now, again, whoops, I'm looking at the US dollar, Japanese yen. What I really want to analyze would have to be the euro, Japanese yen. So just give me a moment to look at it real quick. So, again, euro, Japanese yen, it is going down to new all-time lows. It's sitting at around 97.62. Again, here is the big trade of 2012. It's shorting the euro, Japanese yen chart. The main thesis or the main idea going into this trade is if European banks continue to sell their bond positions, they have to reallocate their money out of Europe. The best way to do that is going into the Japanese yen. Japan has a huge amount of currency reserve, a lot of free-floating currency, a lot of Japanese debt. I just want to go over a disturbing fact for you. The Japanese bond yield sits at around less than 1% at this point. And earlier on in May and July, it was sitting at around 1.4, 1.3, 1.2. And for us at Fully Informed Trade, it wasn't really a big surprise to see Japanese bond notes continue to fall down in yield as the value of, or the actual value of the bond continued to go up. So again, people are playing the bond trade. They're getting yields. Albeit a very small one, a 1% dividend yield, or I guess interest. It doesn't seem like much, but when you manage a $50, $100 billion portfolio for your clients, and you're dealing with economics of scale, you really have to find something worthwhile, an economy large enough to put your money into. Singapore isn't big enough, albeit they have a nice AAA sovereign debt rating. Banks are really secure over there. However, the size of the banking institutions and the amount of stock currency available for people to transfer their currency into doesn't really amount to much, whereas the Japanese economy has tons of stock currency, tons of free-floating M2, M3 currency. Then you have to consider the fact that the Japanese Treasury bond market is worth around $15 trillion. So it does make sense. This trade is definitely still on the table. I have to be bearish, very bearish, the Euro-Japanese yen, and I'm very bullish the Japanese yen going into 2012. Moving on, let's go ahead and analyze the next chart, which is a silver chart. Again, I ran into it thinking perhaps silver was breaking out of a channel. I guess not. Typically that happens a lot. Sometimes you run into a trade thinking it might work out, but usually sometimes it doesn't work out, and it wasn't able to break out of it. Perhaps we'll have to give it some time. Once it breaks out of the channel, though, that's what makes it a very interesting trade on silver. Some people think that it might be setting up for a bull flag pattern, but I just want to watch this very closely. We're looking at these macro factors. We're watching the Italian bond market. Again, if Italian bond yields continue to rise, chances are that means the dollar index will rally because the euro-US dollar will sell off in relation to that. And once the euro-US dollar sells off, that means euro strength, dollar strength. Euro weakness, dollar strength means silver weakness means silver bulls get crushed, silver breaks below that 20-day moving average, and chances are if it breaks below that 20-day moving average, we could head a little lower. So I find it very hard for me to want to invest into silver right now and to make any directional bets, at least not yet. Okay, gold, similar story as well. It's hard to make a directional bet considering our economic climate, and more importantly, the seasonal and macro factors. The macro factors continue to sell, get rid of their bond positions, risk off mentality. Seasonal factors are risk adjusted. People want to, they get a bit more risk. There's a little bit more risk appetite. People want to buy riskier assets for the short term so that they can make some performance in the early year. However, The problem with that trade is that we're trading based upon these different correlations. Dollar strength again implies economic weakness, and again, it is kind of hard to follow all the correlations. But when you sit down and analyze it for quite a while, it does make sense. Because if the European economic zone does weaken and crumble, and economic growth or maybe economic contraction of maybe -3, -5% for maybe 3 to 4 years, that will have a negative impact on the United States. Again, United States could have the same effect since we're having austerity. Government is going to start cutting back on their own spending, at least the U.S. federal government. So all across the board, you're having austerity issues. Austerity issues is bad for bond markets. If bond yields continue to go higher, governments have a lower probability of paying back that money, and that's definitely negative for any commodity bull, because if you have deflation, your commodity is paired to the dollar. Deflation means dollar strength. Dollar strength will negatively impact your commodity no matter which way you look at it, and we are still below that 200-day moving average on the gold chart. Notice that 200-day moving average, you're still below that. 200-day moving average is a very important indicator because, again, anytime a market has been able to close below a 200-day moving average, typically a market has been able to stay. It usually takes around 6 to 8 months for it to ever get back above that, and then that's if it ever does get above that for quite a while. I've seen some stocks break below the 200-day moving average and stay below the 200-day moving average for a really, really long time after falling for around 80–90% in valuation. Sears Holding. I've been talking about the stock for a very long time, or quite a bit on my wall. The main thesis here is the company has rising inventories, rising debt, falling revenues, falling net income, in fact, negative earnings. So negative earnings, falling debt, rising debt, falling stock prices, higher inventories is really bad for a retail stock. I wouldn't short it quite yet because we're running into a double bottom area. But we're going to wait for this thing to bounce, and then it'd be a good opportunity to ride the stock even lower. Take care, folks, and I hope you guys have a great trading session on Monday.